The Swedish Riksbank cut its interest rate yesterday, and attention shifts to the Bank of England meeting today to see if the Bank of England is also getting closer to a summer rate cut. Now, stocks in Europe and in the UK advanced to fresh highs yesterday on the back of this dovish divergence from the European central banks compared to the Federal Reserve, while the S&P 500 in the US consolidated just a touch below its own all-time high level. But bad news from ARM Holdings led to a 9% fall in the after-hours trading and is weighing on investor sentiment in the US futures this morning. So welcome. This is Swissquote's Daily Market Talk. So stock markets on this side of the Atlantic Ocean are better bid these days than their American peers. And I believe that that's mostly due to a combination of, two lofty valuations in the US markets, good, robust corporate earnings from the European companies, and also this expectation of looser monetary policies in Europe and in the UK sooner than in the US. Plus, the AI rally that's been boosting the major US indices looks like it is losing momentum these days. So the SOX 600 index and the FTSE 100 traded at fresh record highs at yesterday's trading session as the S&P 500 stalled. Nvidia, for example, hasn't hit a fresh record since March, and AMD lost more than 30% since its March peak. And ARM Holdings, on the other hand, tanked 9% in the after-hours trading yesterday after lowering its revenue and its profit forecast for this fiscal year. And remember, ARM shares had spiked higher 3 months ago following an upbeat forecast. So the downbeat forecast of late could well weigh further on its stock's valuation. Nvidia's earnings due May 22nd can't come soon enough to confirm or to reject the fear that AI spending might start slowing down. So if that's the case, the US stocks or major US stock indices will need the help of a favorable Fed stance to hold ground near the all-time high levels. But the macroeconomic picture is, it is what it is, really. So yesterday, in this macroeconomic picture, we saw another Fed speaker called Susan Collins echo that reaching the 2% inflation goal in the US could take longer than previously thought, which obviously means that the interest rates in the US could stay high for a longer period of time. So that's obviously not good news for the stock bulls, while Lisa Cook, another Fed member, said that firms have ample earnings to cover debt payments, that financial firms are quite well positioned to absorb financial shocks, and that the commercial real estate risk exists. They are sizable but manageable. So all in all, she didn't sound like there is any sense of emergency for cutting the interest rates in the US, while inflation is comfortably above the 3% level and rising since the start of this year. But yet, yesterday's US 10-year bond auction in the US was mostly average, despite these fears of seeing a slowing demand for these bonds. The US 10-year yield settled at the 4.48% level, and today all eyes are on the 30-year bond auction in the US, which should be, quite eventless as well in theory. So, despite the softening Fed expectations, the long-term US yields at around 4.50% and above remain attractive, very attractive for many investors out there who continue to believe that the rates in the US will have to come down soon at some point in time, and that the Fed said that its next move is probably not a rate hike. So why not? In Europe, however, things look quite different than in the US. We are not dealing with any retreat about the rate cut expectations here in Europe. On the contrary, the Swiss National Bank already lowered its policy rate in the first quarter, remember, due to or thanks to a sufficiently slowing inflation in Switzerland. The Riksbank opted for a 25 basis point cut yesterday, as expected, and said that there could be 2 more interest rate cuts this year in Sweden. The European Central Bank is expected to cut its own interest rates when it meets in June, and the Bank of England will maybe, but just maybe, give more details on its own plans to cut the interest rates at today's MPC decision in London. So what's interesting here is the European and Brits' determination to ease their own monetary policies regardless of what the Fed will do, with the risk of obviously seeing the euro, the pound and the krona and the Swiss franc will depreciate against the US dollar and reboost the domestic price pressures, as obviously a stronger US dollar is no good for inflation in the rest of the world. Yet, the policymakers' new slogan here in Europe is, we are data dependent and we are not Fed dependent. And that will apparently, keep them on this dovish diverging path, that as long as the US dollar's appreciation remains manageable and it doesn't hammer the domestic price pressures and the domestic currencies. So for now, the undiscourageable Fed does keep the US dollar appetite quite contained. The US dollar index trades at the highest level since last November, but it is around 8% lower than the 2022 peak when the US Federal Reserve was leading the policy tightening game. The euro dollar is on a bearish trend since December, but here as well, we are far from below parity that the pair experienced back in 2022. Cable trades around the 1.25 level, also much better than the September 2022 dip, which brought it almost to parity. The Swiss franc, on the other hand, has now stepped into the bearish consolidation zone against the US dollar, or say the dollar franc has stepped into the bullish consolidation zone following the Swiss National Bank rate cut in the first quarter of this year. But a softer Swiss franc is something very much desirable for the Swiss economy that relies on exports, obviously as long as inflation remains within target in Switzerland. While the Swedish krona is, it's not sexy at all, but apparently, Sweden has also shifted focus to the domestic slowdown rather than its currency's depreciation against the US dollar. And as long as this focus on domestic economies continues, which will obviously require a steady slowdown in inflation in tandem, we shall continue to see the European currencies depreciate against the US dollar, where the Fed is, much more hawkish than at the start of this year. And the latter could reverse, but if and only if and when inflation reports in Europe start showing the impact of a stronger US dollar. So this is also why I actually think that we don't see a stronger sell-off in the European currencies against the US dollar, because of this fear of seeing inflation return to Europe and reverse this dovish central bank expectations from the European central banks. But anyway, today, the Bank of England is not expected to cut its rate, but the MPC is expected to agree less on when to cut the interest rates in the UK, and that's how the sterling traders will be guessing the potential timing of the first interest rate cut from the Bank of England. For now, there are 4 MPC members out of 9 who are sitting in the hawkish camp, but Governor Bailey has shifted his stance from we are nowhere close to interest rate cuts and it's too early to talk about them too. Inflation dynamics between the US and UK are diverging, so we can cut rates. So some see a small chance that the Bank of England could cut its interest rates in the June meeting, as the European Central Bank is also planning to do. But a more realistic scenario is probably an August rate cut the earlier. So we will have more details and more clarity on what the MPC members in the UK think and how these expectations regarding the Bank of England will shape after the meeting. Walking into the meeting, cable trades in the bearish consolidation zone, as it is now below the major 38.2% Fibonacci retracement on October to March rebound in cable. And unless we hear anything unexpectedly and surprisingly hawkish from the Bank of England, and there is no reason for it in my opinion, cable should continue to attract sellers near the 1.25 level into next week's US inflation report. Then things will likely take a clearer turn, because the inflation report is really what really matters for the entire world right now. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.